Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just get right to the tape from January 16th, 2026. NASDAQ, ticker ALM, closed at US dollars 86 cents. Over on the TSX, AII finished at C dollars 12.09. But look, if you're only looking at the closing price, you are missing the entire story here. The real story is in the churn. We're seeing daily volume hitting, 600,000, sometimes 800,000 shares on the Toronto Exchange alone. I mean, for a specialty metal stock, that is not just noise, that's a changing of the guard. So we're looking at a classic high-volume consolidation right after that huge news in December, commercial production starting at the Sangdong mine and that massive US $129 million equity raise.
Right.
So the central question we are debating today is, I think, pretty clear. Is Almonty Industries a fundamental, infrastructure play that's solving a critical Western supply chain crisis? Or is it more of a geopolitical betting slip priced for absolute perfection right now? I'm arguing that Almonty has graduated. It's now a strategic must-own asset. And what looks like volatility is actually institutional accumulation.
And I'm looking at that exact same tape, that exact same volume, and I see something completely different. I see a valuation that has been stretched to its limit by a narrative that is, frankly, heavily reliant on geopolitical tension staying exactly where it is. And it's facing massive execution risks during the most dangerous phase of any mining project, the ramp-up. So while the story is compelling, and look, I'm not denying it's a good story, I think investors are paying a huge premium right now for what is essentially a call option on trade wars. And that valuation basis is incredibly fragile. We're seeing a clear technical rejection at $13.75, and I think that might be a hard ceiling.
Well, before we get into the tick-by-tick action, we have to ground this in the macro reality. You just can't value Almonty in a vacuum. The price action we're seeing, this churn around $12, is actually very healthy behavior inside of a breakout. We're dealing with a Western supply vacuum. China controls something like 85% of the tungsten market. The export controls on gallium and germanium back in 2023, that was the wake-up call. That was the warning shot. Now, here in 2026, the market is finally pricing in the absolute strategic necessity of the Sangdong mine. This isn't just about digging rocks anymore. It's about national defense. And that recent US $129 million raise, that was the final piece. It completely eliminates funding risk. The balance sheet is a fortress now. This isn't a junior miner anymore. It's the tungsten fortress for the defense and semiconductor industries.
I understand the fortress analogy, I do. And I agree the balance sheet is strong, cash solves a lot of problems. But I'm looking at the cracks in the foundation of that valuation. There's a sort of valuation arbitrage happening. It feels disconnected from the fundamentals. You call it consolidation, but I see a technical rejection. The stock tested $13.75 on January 6th and just could not hold it. That tells me the market is hesitant. It wants to see proof of cash flow before pushing higher. And we are in the ramp-up phase. In mining, it's known as the valley of death. This is where your mechanical failures pop up. This is where you find out your recovery rates are coming in at 60% instead of the 85% from the study. I mean, transitioning to steady-state production is notoriously difficult, and the market is pricing this stock as if the mill is already running perfectly. If they miss one quarterly target during this phase, that premium could just collapse.
I see why you'd think that. And normally, for a junior miner, I would 100% agree with you. But let me offer a different perspective on that ramp-up risk here. We're not talking about a greenfield discovery in the middle of nowhere with, completely untested metallurgy. Sangdong was the leading global tungsten producer outside of China until 1994. The geology is known. The metallurgy is known. They've been running pilot plants for 3 years. So that risk, the risk that the chemistry just doesn't work, is significantly lower than you're implying. But let's get into the market mechanics, because I think you're misinterpreting who is selling and why the volume is so high.
I don't think I am. If we want to talk about signals, let's talk about the signals coming from inside the building. The most potent signal often comes from the people with the keys. You have a director, David Hanrich, who executed a full exit. He sold, what was it, about $1.7 million worth of stock around $13.21 in January. This isn't just trimming a position to buy a boat. This is a complete liquidation. When an insider sells out entirely at $13, it suggests that internally, that price level is seen as full value. If the tungsten fortress is just getting started, why is one of the directors cashing out completely?
Okay, it's a fair data point, but context is everything when you're analyzing insider moves. You have to put that sale in perspective. The stock was up over 700% in a year. Hanrich's sale is personal financial management. It's taking chips off the table after a life-changing run. It does not necessarily reflect a lack of conviction. You can't expect every insider to hold every share forever. And you have to contrast that with the CEO, Louis Black. Back in November 2025, just before the big announcement, he bought roughly $316,000 worth of stock. That's real skin in the game. But more importantly, you're looking at one person. I'm looking at an institutional tidal wave. Let's talk about the dark pool data. The off-exchange short volume ratio is frequently over 50%.
Which to the average investor looks like a massive bet against the company. It implies bearish sentiment. If half the volume is short volume, that has to mean people are betting it goes down, right?
Exactly. And that is the key misconception we need to clear up. In this specific context, high short volume is not bearish betting. It's market makers facilitating trade. When a big institution, say a fund buying $10 million worth of stock, comes in, they don't do it on the open market. It would spike the price instantly. So they go to a dark pool. The market maker sells them the shares, technically shorting them to fill the order, and then covers that position over time. So this creates short volume on the tape, but it's actually driven by huge buying demand. This is how the smart money gets in. We're seeing funds like Driehaus Capital, which is a momentum shop, Alyeska, which is event-driven, Hood River's in. This proves a rotation is happening from retail hands to strong institutional holders who are positioning for a multi-year cycle.
I'm not entirely convinced that's the whole story. While these institutions might be getting in, we have to ask why they're getting in. And they're doing it based on a narrative that is highly correlated to one single variable: geopolitics. This brings me to the polymarket correlation. We are seeing a nearly one-to-one lockstep between Almonte's stock price and the betting odds on polymarket.com for the question, will China lift rare earths export ban?
It acts as a proxy, yes, but that just validates the entire thesis. It shows the market understands the drivers.
I think it's more than a proxy. It's a tether. The stock is moving based on the probability of those bans being lifted, sitting at, what, less than 5 or 10%? So the market is pricing Almonte on the idea that this resource iron curtain stays closed forever. But here is the danger. Politics is fickle. If there is a thaw in relations, even a minor one, or if those polymarket odds shift, that scarcity premium just evaporates instantly. It won't matter how much ore Sangdong mines if the market suddenly thinks Chinese supply is coming back. You think you're buying a mining stock, but you are effectively holding a betting slip on continued diplomatic failure. If the diplomats succeed, the shareholders fail.
I accept the correlation, but I see it as a feature, not a bug. It acts as a positive long volatility hedge. In a diversified portfolio, you want assets that do well when the world gets chaotic. But to suggest the resource iron curtain is temporary is to ignore the structural reality of modern defense. We're not talking about tariffs here. We're talking about the physical requirements for armor-piercing munitions for hypersonic missiles. Lockheed Martin, Raytheon, they cannot source from China anymore, period. The supply chain has fractured permanently.
But is that fracture worth $10 a share right now? That implies a lot of future cash flow is already banked.
The market seems to think so. And look, Almonte has a hedge on your hedge. They have the Gentung Browns Lake project in the USA that gives them access to Title III funding under the Defense Production Act. So it's essentially a pot of money the U.S. government uses to subsidize domestic production of critical materials. It also brings Buy American protectionism into play. So even if the global picture shifts, the U.S. domestic requirement for tungsten keeps a floor under the valuation.
Okay, let's talk about that valuation because that is where the rubber really meets the road. You are paying a massive premium here compared to the rest of the sector. When you look at the peers, the math just doesn't always line up with the hype. When you look at market cap per unit of production potential, Almonty is trading in the stratosphere.
I disagree. The premium is justified by asset quality. You can't compare a Ferrari to a bicycle just because they both have wheels. Look at the peer group. You have Moss and High-Tech in Vietnam. They're distressed. Their grade is low, around 0.19%. They need a parent company's support to keep the lights on. Then you've got EQ Resources in Australia. Good company, but smaller scale, they're reprocessing tailings. Almonty is the only real sector heavyweight. We're talking about Sangdong handing grades of 0.45 to 0.50% WO3. That's double or triple the global average. That grade protects the margin. And we can't ignore the KfW debt facility.
The $75.1 million loan?
Exactly. Backed by the Austrian Export Credit Agency. You know as well as I do banks like KfW, conservative, state-owned European banks, they do not throw money at speculative mining plays. That facility is a seal of technical approval you rarely see in this sector. It validates the engineering in a way an analyst report never could. It tells us the due diligence has been done by people who lose their jobs if they get it wrong.
That's a compelling argument for the quality of the asset. I'll grant you that. But have you considered the expectations built into this price? Analysts, even the bullish ones with $14 or $15 targets, are projecting a J-curve revenue jump. We're talking about going from about $44 million in revenue to over $526 million by 2028. That's a 10x explosion in revenue in 2 years. That is priced for absolute flawless perfection. The stock is trading as if that's a foregone conclusion. And I have to remind everyone of the history. Sangjiangdong was closed in the 90s. Why? Not because it ran out of tungsten, but because of Chinese dumping prices. If that China ban narrative fails, Almonty has to compete on pure cost again.
But that's where the grade saves them. They're in the lowest quartile of the cost curve because the rock is so rich. They can survive a price war that would kill their competitors.
Low cost, yes, but not immune to a price crash. And I have questions about the Moly kicker. They talk a lot about the Moly offtake with Seya Group, which has a $19 per pound floor. That's great, but is it enough to protect margins if tungsten prices crash? Moly is a byproduct. It's essentially free money, but it's a small part of the overall revenue mix. If geopolitical tension eases and tungsten floods the market, that Moly credit helps, but it doesn't say the valuation at these levels. You're asking investors to pay for 2028 earnings today in 2026, assuming no breakdowns, no strikes, and no peace treaties.
I just see it differently. The molybdenum offtake basically subsidizes the tungsten production. It drives the net cost of tungsten down even lower. Some estimates say it covers almost all the processing costs. And as for the peers, the market is bifurcating. You have Chinese miners like Xiamen Tungsten, which are just uninvestable for Western ESG and defense funds. All that capital has to go somewhere. It's being forced into the very limited pool of Western producers. Almonty is the largest, most liquid boat in that harbor. The non-China premium is a structural re-rating of the whole sector, not a temporary hype cycle.
Okay, but we are running up against the clock, so let's summarize where we are. Almonty Industries it's undeniably a compelling story. The geology at Sangtong is world-class, the geopolitical tailwinds are real, but buying at these levels, $8.67 USD, $12.09 Canadian, requires a belief system. You have to believe execution will be flawless, and you have to believe that global tension is permanent. That volume spike, the volatility, it shows a battleground, and that director's complete exit suggests caution is warranted around the C$13 resistance level. I see a company priced for a future that hasn't happened yet.
And I maintain that Almonty has graduated. It is no longer a mining stock, it is strategic infrastructure. The dark pool activity, the institutional rotation, it all signals a multi-year bull run underpinned by a structural deficit of non-Chinese critical minerals. This consolidation we are seeing right now around C$12 is an entry point before the revenue really starts to ramp up later this year. The resource Iron Curtain isn't going anywhere, and the West is finally paying the correct price for security.
It is a unique proxy for the fractured global order, no doubt about that.
Indeed. Ultimately, the listener has to decide if they're betting on the mine or if they're betting on the war. That's all for today.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.